You spent decades building up your RRSP. You've contributed consistently, taken a tax deduction, watched it grow year after year, but now you're nearing retirement and facing a big question. What do I actually do with all this money? Because here's the truth. The RRSP was designed to help you save for retirement, not to help you spend in retirement. And when it's time to convert your RRSP into a RRIF, most Canadians are caught off guard by how it really works. What many don't realize is that every withdrawal from your RRIF is fully taxable. Your government benefits like OAS could be clawed back. And if you don't plan properly, you could accidentally trigger a higher tax bracket year after year. And by the time you realize the mistake, it could already be costing you thousands. In this video, we'll break down exactly what happens when you convert your RRSP, how RRIF withdrawals work, and the key strategies I use with my clients to turn retirement savings into tax-efficient retirement income. If you're within 5 to 10 years of retirement or already retired and not sure how to draw from your RRSP, this one is for you. Hi, if you're new here, my name is Darcy Bell, and I'm a certified financial planner professional with IG Wealth Management. I work with Canadians across the country to help them grow, protect, and convert their wealth into sustainable income, especially as they approach retirement. And today, we're talking about one of the biggest shifts in retirement planning. What actually happens when you convert your RRSP to a RRIF, and what you need to know before you do it. Let's get into it. Part 1, what is a RRIF and how does it work? Most Canadians are familiar with how an RRSP works. You contribute pre-tax dollars by reducing your taxable income, and your investments grow tax-deferred for years, sometimes even decades. But once you turn 71, the RRSP clock runs out. The government says it's time to start taking money out, and that's where the RRIF, or Registered Retirement Income Fund, comes from. Think of the RRIF as the next phase of your RRSP. It doesn't change your investments. You're not forced to sell anything when you convert. You're simply changing the purpose of the account from accumulating wealth to generating income. The government requires you to convert your RRSP to a RRIF by December 31st of the year you turn 71. Then, starting the next year at 72, you're forced to withdraw a minimum percentage each year for the rest of your life. Here's how it works. You can convert your RRSP to a RRIF anytime before 71. And in some cases, it makes sense to do it earlier. More on that later. Once you convert, you can no longer contribute to the RRIF. It's a one-way street. The government sets minimum withdrawal amount based on your age. For example, at age 65, the minimum withdrawal is 4%. At 71, it's 5.28%. At 80, it's over 6.82%. And by age 95, the minimum jumps to 20% annually. Every dollar you withdraw is fully taxable as regular income. Just like a paycheck, you can always withdraw more than the minimum, but never less. Let's say you have $600,000 in a RRIF at age 71. Based on the government's table, you'd be required to withdraw at least $31,680 that year. And that amount gets taxed just like employment income. And that's the part many Canadians don't realize. Once you start pulling money from your RRIF, you could be in for a much bigger tax bill than you were expecting, especially if you have other sources of income like CPP, OAS, rental income, or even part-time work. Even worse, if you don't plan carefully, your RRIF withdrawals could push you into a higher tax bracket or trigger the dreaded old age security clawback, which starts once your income crosses about $93,454 in 2025. So while converting to a RRIF is mandatory, how you draw from it is strategic. And that's what we'll focus on next. Part 2, why RRIF withdrawals can hurt more than you think. Most Canadians assume that tax bill will go down in retirement. After all, you're not earning a full-time salary anymore, so shouldn't your income and taxes drop? But here's what actually happens when you start drawing from your RRIF. Your withdrawals are fully taxable. Every dollar you take from your RRIF counts as regular income, just like employment earnings. So let's say your total retirement income includes $20,000 from CPP and OAS, $15,000 from a defined benefit pension plan, $30,000 from RRIF withdrawals. That's $65,000 of total income. And depending on your province, that could easily push you into a 30 to 40% marginal tax bracket. And remember, if you have a RRIF, you must draw the RRIF minimum. But if you withdraw too much, you could lose even more of your retirement income to tax. Your OAS could get clawed back. Old Age Security, or OAS, is a monthly government payment that kicks in at age 65. But if your income is too high, the government starts reducing your OAS payments, known as the OAS clawback. In 2025, the clawback starts at $93,454 of income. For every dollar you earn above that, you lose 15 cents of OAS. So let's say you earn $100,000 of income. That's $6,546 over the threshold. You'd lose 15% of that overage, or $982 of your OAS benefit. That's real money, especially over time. And guess what can push you over that limit? Unplanned RRIF withdrawals, a large RRIF conversion, a spike in investment income like selling shares or mutual funds without proper planning. A single RRIF withdrawal can reduce your government benefits and raise your overall tax bill, all in the same year. No more control over withdrawals. One of the big drawbacks of RRIFs is the lack of flexibility. Sure, you can withdraw more than the minimum, but you can't choose to withdraw less, even if you don't need the income. That means you could be forced to take income you don't need. You'll pay tax on money that might just sit in a savings account. You're increasing your taxable estate, which your family could pay tax on later. And the older you get, the faster the minimum withdrawals increase. At age 85, the minimum is 8.51%. At age 90, it's 11.92%. By age 94, you're required to withdraw 18.79%, nearly 1/5 of your account every year. This can accelerate the decumulation of your RRIF and result in more tax in the later stages of retirement, when you may not need as much income. RRIFs are taxed heavily at death. Let's say you worked hard to grow your RRSP to $1 million and convert it into a RRIF at retirement. You take only the minimum withdrawals each year to preserve your wealth. But if you pass away without a spouse or qualifying beneficiary, the entire balance of your RRIF is added to your final tax as income, all in 1 year. That $1 million could face a combined federal and provincial tax rate of 40 to 50%, depending on your province. That's $400,000, $500,000 gone to taxes before your estate gets a dime. Even if you have a spouse who rolls over the RRIF tax deferred, you're simply deferring the tax, not avoiding it. Eventually, someone's going to pay tax on that RRIF. And without the right planning, it could be the CRA that gets the biggest inheritance. Part 3, how to minimize RRIF taxes in retirement. The good news is, just because RRIF withdrawals are taxable doesn't mean you're powerless. In fact, with the right strategy, you can reduce your effective tax rate, preserve government benefits like OAS, maximize the after-tax income your RRIF actually gives you. Here are several practical strategies I use with clients to help draw down RRIFs smartly, not just automatically. 1. Start withdrawals before you have to. Most Canadians wait until 71 to convert their RRSPs to a RRIF, and then begin withdrawals the following year. But sometimes it makes more sense to start drawing earlier, especially if you've retired in your early 60s and your income is temporarily low. You're delaying CPP and OAS until 70. You have no other major income sources. By drawing down RRSP funds early when you're in a lower tax bracket, you can pay less tax per dollar withdrawn, reduce the size of your RRIF before minimums kick in, avoid large forced withdrawals later that trigger OAS clawbacks or higher tax brackets. Example, if your only income from ages 60 to 65 is $20,000 a year from part-time work, drawing an extra $20,000 from your RRSP could still keep you in a low tax bracket, often around 20%. That's a strategic opportunity that disappears once you start collecting CPP and OAS. 2. Split RRIF income with a spouse. If you're 65 or older, RRIF income qualifies for pension income splitting, meaning you can shift up to 50% of your RRIF withdrawals to your spouse's tax return. This can be a game changer if your spouse has little or no income. One of you is about to hit OAS clawback threshold. You're both hovering around different tax brackets. Income splitting lets you reduce your combined household tax bill, avoid OAS clawbacks, equalize retirement income for better long-term planning. It's one of the most powerful yet underused RRIF strategies available to retirees. 3. Use TFSA contribution room wisely. One of my favorite tax planning combos is this. Draw modest RRSP withdrawals each year, before or after RRIF conversion. Use the after-tax dollars to contribute to your TFSA. Why? Because once it's in the TFSA, that money grows tax-free and can be withdrawn at any time with no tax impact on your future income. This helps shift money from a fully taxable account, RRSP, RRIF, to a non-taxable one, the TFSA. Lowers the future size of your RRIF, increases your tax-free income options in retirement. If you're 65 plus and have unused TFSA room, this should absolutely be part of your planning strategy. 4. Plan your withdrawals around other income sources. You don't want to pull large amounts from your RRIF the same year you sell a rental property, sell non-registered investments with capital gains, trigger deferred stock options or severance payments, sell your business or farm. All of these events can spike your income and push you into higher tax brackets, sometimes even beyond the top marginal rate. Coordinating RRIF withdrawals around other taxable events can help you smooth your income and reduce the total tax bill over time. This is where a comprehensive retirement income plan makes all the difference. It's not about what to withdraw this year. It's about designing a decade-long strategy. 5. Consider a partial RSP to RRIF conversion. Remember, you don't have to convert your entire RSP to a RRIF all at once. If you only need $10,000 per year, you could convert $50,000 to a RRIF now. Leave the rest in your RSP. Top up your TFSA with after-tax dollars. Reevaluate next year based on income and tax situation. This gives you more control and helps you avoid triggering unnecessary withdrawals. Partial RRIF strategy is especially useful if you're between 65 and 70 and want to start income splitting. You want to test how RRIF withdrawals impact your overall plan. You don't need full minimum withdrawals from a large RRIF. These are just a few of the strategies I walk through clients with every day, because in retirement, it's not just how much you've saved, it's how you take it out that determines what you keep. Part 4, should you convert before age 71? This is one of the most overlooked strategies. Just because you're not required to convert until 71 doesn't mean it's the best time to do it. Let's say you retire at 60 and have a few low-income years before government benefits kick in. That could be the perfect window to convert part of your RSP to a RRIF. Take out small withdrawals while in a low tax bracket. Fill up your TFSA with tax-efficient income. Reduce your future minimum RRIF withdrawal amounts. This approach, called income smoothing, can significantly reduce your lifetime tax bill and help you preserve your government benefits longer. Part 5, RRIF rules that can work in your favor. There are a few planning tricks that many Canadians don't take advantage of. You can base withdrawals on your spouse's age if they're younger, reducing your required minimums. RRIF income qualifies for income splitting at age 65. You also get access to the $2,000 pension income tax credit. The minimum withdrawal amount is not subject to withholding tax. Only amounts above that are. These small details can make a big difference in how much tax you pay and how long your savings last. RRIFs aren't just a formality. They're a major turning point in your retirement plan. When you convert, how much you withdraw, and how that fits into your broader income and tax strategy, all of it matters. If you're unsure about how or when to start drawing from your RSP, or you want a personalized RRIF income strategy, click the link in the description to book a free call with me or my team. We'll walk through your numbers, answer your questions, and help you build a smarter retirement income plan so you can retire with clarity and confidence.